When cryptocurrencies such as Bitcoin or Ether fall in value, the idea of buying the dip and riding crypto to its next stratospheric peak can be very appealing. However, previous to last week's meltdown, when the price of Bitcoin dropped about $8,000 between September 7th and September 10th, the world's most well-known cryptocurrency lost at least 30% of its value in a matter of weeks. That level of turbulence isn't for everyone. Fortunately, there are ways to profit from crypto's current rally without buying any actual cryptocurrency. That's what we'll be looking into today. Before we move on, don't forget to drop a like. If you're new here, don't forget to smash that subscribe button and click on the bell icon to turn on post notifications. So without further ado, let's get started. In this video, we'll tell you 5 ways to profit from a crypto crash. Number 1. Buy on the dips. This is a basic but kind of risky investment strategy. Buying the dip basically means buying an asset when its market price dips or lowers. After an asset's price dips, investors buy the assets at a lower price and hope to profit as the market rebounds. This has different odds of working out in our favor. Some traders buy an asset that's on long-term upward climb and take a dip suddenly. This way, when the uptrend resumes soon, the profits start raining in. This is done for immediate returns. Others buy it when there is no particular uptrend and it goes at a steady pace. They do this in hopes that the uptrends may occur in the future and there will be a future rise in price, and consider this a future investment. Some risk takers who have already bought into it buy the asset when it's ranging down steadily. This results in a net lower price while buying, but if there is no uptrend in the future, you would be at a loss. This is called adding to a loser. Buying when the price dips in no way guarantees a profit. We cannot say if a temporary dip in the market value is, in fact, temporary, or if it would drop all the way due to an underlying problem that changes its value. One thing you need to pay attention to is cutting your losses. This is a method of risk control. Set a limit for how much you're willing to lose. When you buy a stock when it hits a dip, you assume that it will go up in the future. If it keeps dropping and reaches the limit you've set, cut the loss so that you don't lose much money. Unless you're a long-term buyer, it is suggested you buy an asset that dips temporarily from an uptrend. Number 2. Short selling crypto. In short selling, the aim is to sell high and buy low. This is done so that you can profit from the lows by basically betting against the highs. The profit comes in when the price moves between when you sell it and buy it back. Sounds easy, doesn't it? Well, it's more complicated than it sounds and very risky. Bitcoin is a very volatile currency. Its value appreciates and depreciates just as quickly. Shorting volatile assets like Bitcoin can either result in huge profits or massive losses, and because it's one or the other, this is mainly preferred by risk takers. You can short crypto on platforms like Binance or KuCoin. Everything works on speculation here. Traders who speculate the fall of crypto can open a short position so that they can profit from the fall. Let's look into how it's done. First, traders borrow crypto from a lender and resell it immediately. If the price drops, they buy it back at a low price. The problem is that the chances of loss are through the roof, as there is no limit as to how much crypto value can rise. On the other hand, it can't fall below zero, so there is, unfortunately, a cap on how much profit you can bring in. This is the exact opposite risk probability of going long, where you have uncapped profits and the losses have a limit. This has a limited growth potential. Next, we have number 3, USDTs. When you're investing in crypto, you usually set a limited amount of money to invest, and more often than not, you spend all of this money on your crypto. But instead of doing this, what you should be doing is setting aside some money so you'd always have some ready to trade. But if you have money sitting idle, wouldn't it be wiser to invest that as well so you can actually make more money? It would be, and there is a way to do that. That is to lend as liquidity. USDT or Tether is a stable coin. What does that mean? Allow me to explain. USDT is a coin that is designed to be more stable. It is less volatile in the market and is often pegged to real-life commodities or assets. Stablecoins can fall into the category of real-life currencies like the dollar or the euro. This is a coin that has been stirring up a lot of controversy in the crypto space. While coins like Bitcoin and Ethereum are good investments and give more significant returns, they are volatile coins, and when the market crashes one day, your losses go up. Traders usually invest in USDT to secure their financial position in case this were to happen. Tether is tied on a 1-to-1 ratio with the dollar, and so for every coin in existence, there is a dollar in the vault. This means that you can take your Tether coin to any corner of the world and withdraw it for cash just as easy as Bitcoin. It might not be quick, but it's hassle-free money, which attracts traders to USDT. Lending USDT is a good source of passive income as you make money from assets you are not currently using. It's so easy and simple that even beginners in the crypto world can do it. All you need to do is lend your crypto to a trader so they can increase how much they invest to maximize their scale of trading and profits. But you need to make sure that you'll get your assets back. How can that happen? The answer is simple. For a fixed amount of USDT you lend, they have to deposit an equivalent to some other crypto asset which they don't need at the time. The platform automatically sells the collateral and gives the proceeds if something were to happen. See, I told you it's simple. Moving on to the next, we have number 4, altcoins with a price floor. Altcoins are coins with high volatility, even more than bitcoins, and being this volatile has an upside. When you're buying the dip, your profits increase with downtrends, and altcoins being more volatile will have deeper dips. When bitcoins drop, altcoin takes a dip as well to people leaving projects and such, but not everyone leaves and decides to sell. Some people hold on to their altcoin. These are the people that set a price floor. It may be hard to know what the price floor actually is, but once you get an idea, it reduces the risk on your part. If or when the market crashes, it gives an excellent opportunity to invest or buy in a promising project which might be in an all-time low or at the ground price. Now, since you know the price floor or at least have an idea, you know that it wouldn't exceed it, so there isn't much downside potential. It's not a solid rule, but nothing in crypto is. Crypto is all about taking risks, but it's a good idea to actually know something about the project you are buying into and make sure that there's a solid team behind it. Next comes the easiest and straightforward method, and that is number 5, HODL. HODL basically means to hold on for dear life. HODL is actually a lingo in crypto. A trader in a hurry misspelled hold in an online forum back in 2013, and from then, this has become a mantra of sorts for nervous traders to ride out the lows. This says that even if the market crashes, instead of selling, hold on to your assets and trust in the long run. This would be advantageous. These are traders that are in it for the long run. Some say to do this because they love the project they are investing in and believe that it will come through. Others may do it because they believe that they are in too deep to pull out now, and some are just too lazy to withdraw and decide to let it ride out. It does sound scary, but it has been seen that ones who hold on and refuse to sell usually top the ones who sell according to dips and rises and try to time the market. Holding is a very efficient way to get profit and come out with more money tomorrow. Which one of these are you going to try when the market crashes? Let us know in the comments down below. We hope you liked our video and found it helpful. If you did, don't forget to drop a like and share it with your crypto-loving friends. That's all for today, guys. We'll be coming up with more exciting videos. Stay tuned and turn that post notification on so that you won't miss out on any of our upcoming content.